But to start this morning, we're going on a sort of around the world in 60 minutes of property markets, surveying the scene in the US, Europe and Asia, as well as here at home. Property is a particularly interesting asset class right now, with negative interest rates in various parts of the world and countries like Germany teetering on the brink of recession. And in Australia, of course, there's a real question over just where our domestic residential property market is. If you looked at the weekend news headlines, you'd probably think that the worst was without question over. But the focus of this session is very much to look internationally. And please do join the conversation, of course, as you did yesterday, either using one of the floor mics or via the app. Just make sure that you choose the correct room to get into the right area, so you are actually asking your questions into this forum. We are in the Plenary Federation Ballroom. To kick off the discussion, the poll question for this session. Over the next 12 months, what are your expectations for returns from property? Increase, decrease, stay the same? This is probably the most general question you could possibly get. It's geographically agnostic, it's sector agnostic, but curious to get your thoughts. And while you ponder that, let me introduce our speakers for this session on the global property marketplace. Anne Cole, on the left, is the Global Head of Real Estate Client Strategy at Morgan Asset Management, and she joins us from the US. Tony McCormack is Chief Executive Officer, International Property Funds Management, and Ling is the Chief Executive Officer and Chief Investment Officer, M&G Real Estate Asia. She's joining us from Singapore. Please welcome our panel. So let's just, before the speakers have a chance to give us a bit of a lay of the land of their sectors, let's have a little look at these poll results. So, I don't know, optimistic? Is there anything there that surprises you? I mean, as I said, it's a terribly agnostic poll. Tony, 39%, are you surprised by that optimism?
I am.
Oh, you are?
I am.
What did you think was a more realistic response?
Well, there's not much difference between, actually pretty even, but I would have been thinking with where property returns have been this year, which is core property returns in Australia. And I assume most people are probably thinking about their Australian exposures. They've been around 7 to 8%. The year before they were 12 to 13. If I just followed the trend, I'd be thinking that, and with everyone knowing that there's some pretty big issues in retail, and maybe people don't know whether it's been fully factored in or not. I personally don't think it has been. So I would have been thinking that next year's returns will be lower.
Let's just do a quick show of hands. Those who did answer the poll, were you thinking from an Australian perspective? No one was thinking from an Australian perspective? Oh yes, yeah, a few were. Obviously it was a pretty broad view. Any thoughts on the results? Are you surprised?
I was a little surprised. I was expecting a little bit more of stay the same, quite honestly.
Chiang?
Actually not surprised because while we have stress in the retail sector, the office and industrials are doing quite well. And with interest rates going down, it's actually been quite a winds in the sail for real estate as a whole.
Well, obviously that shows that there is different sectors, different markets and different focuses and responses for those. So let's hear from each of our speakers about their particular sectors. Anne, you're up first, presenting on the US.
Thank you. And we don't have a clicker.
Is the clicker on the ground? That is the question.
Ah, there it is. Okay, we have a clicker. Okay. Good morning, and thank you for allowing me to speak with you today. It's my first time in Hobart, first time in Tasmania. It's quite beautiful, so next time I come back, I think I'm going to bring my hiking boots because I hear there's a lot of great walking trails around. So looking forward to that. So our topic today is global real estate, and why you put a global real estate portfolio together, and really why now. And I think the real question is, why wouldn't you have a global real estate portfolio, quite honestly? And so I'm the first speaker today, and I'm going to talk about sort of the why you would have a global real estate portfolio, then really focus on the U.S. sector, why that should be a meaningful component of that global real estate portfolio, and then turn it over to my esteemed panelists, who are going to, Tony and Ling, who are going to talk about Europe and Asia and investing in those regional markets. So, as Ellie said, I work at JP Morgan, and when I think about the conversations that we have with our clients, we manage about $2 trillion of assets for clients broadly across different asset classes. And when we have conversations with our clients about the equities markets, it's always a global conversation. We never have the conversation of you should go global. It is always more about what geographic regions, what risk profile do you want, what kind of strategies do you want as you put a global portfolio together. When we talk to our real estate clients tend to be home biased. It's just a natural, I think, position for real estate investors. Real estate tends to be local. And so it doesn't matter what country you're from, you tend to have that sort of home bias as you think about your portfolio. But the reality is, when you think about real estate, the rationale for going global in equities, it's the same in real estate. And I'd actually make the case that it's actually better in real estate because real estate is more local just in a general way. And so you get more diversification from a global real estate portfolio than you even get from an equities portfolio when you think about multinational companies being located in different equity markets. And so with that, I want to talk about diversification. And diversification is the reason why you're putting this global portfolio together. You're looking at correlations, you're looking at volatility, you're looking at that mix. And so that's really going to be the theme for the conversation that we have this morning. And so when you look at diversification, the reason why you have real estate in your portfolio is because it provides that diversification relative to your equities and your fixed income portfolio, which is where you have the majority of your assets, right? So institutional investors have generally put about a 10 to 15% allocation to real estate in their broader portfolios. And so if we think about why you're doing that, it's you're thinking about those correlations. And so when we look at this chart here, we're looking at over the last 20 years correlations by the geographic real estate region. So we've got US core, European core, and APAC core, relative to global equities, Australian equities, global fixed income, and Australian fixed income. And what you can see on the far right-hand side is that within the three regions, from a real estate perspective, you've got moderate correlations, right? So it makes the case for why you would put a global portfolio together. You're going to get that natural diversification by investing across these three regions in a portfolio. But more importantly, the reason why you have real estate to begin with in your portfolio is diversification relative to equities and fixed income. And here you can see the power of a global portfolio, right? You can see negative correlations relative to your fixed income portfolio and relatively low correlations relative to your equities portfolio, right? So you get the power of a global portfolio is very, very strong, right? So here's where I'm going to diverge and start talking about the US markets. Right? So hopefully I've made the case for why you want to go global, why that's going to be important to your broader portfolio, and now thinking about the US, right? So why the US? When you look at these numbers, you can see here is that the US has an even lower correlation relative to Europe and APAC, particularly when you look at the equities markets. So why is that? So contrary to what many people think, the US is actually relatively insulated from the global economy, from other countries, right? So the US GDP, the US economy, is very much driven by domestic industries. About 70% of the US GDP is driven by domestic, right? We're not an export reliant economy. Less than 20% of the US GDP comes from exports, right? So that drives that lower correlation, right? The next piece of it is size. And size matters. So when you look at the pie chart on the left-hand side, is the US is the largest market in which you can invest. So there's about $8 trillion of investable real estate across the globe. About 40% of that is in North America, primarily the US, right? So it's the largest market. So when you start thinking about being a real estate investor, how do you not invest in the largest market? And thirdly, and I think this is most importantly, is that you've got the best diversification within the US market. So when you think about different countries and regions, very often you're relying upon one city dominates or a few cities dominate that country or that region, In the US, you've got much broader diversification. So if you look at New York and you think about how large the New York market is, it's only 10% of the US real estate investable market. If you look at our top 5 markets in the country, they're only 42%. Right? So as you curate a portfolio, you pull a US real estate portfolio together, you have tremendous opportunities for diversification and for picking different drivers, picking different markets, sub-markets within those markets to pick the different drivers of the US economy. And by way of example is Los Angeles, right? So Los Angeles is one of our top 5 markets in the country and is one of our faster growing markets today. We always think of Hollywood, but now we've had the convergence of Hollywood and technology, right? What that does is Los Angeles is now the location for where all the content, for all the streaming that we're all doing on our phones and on our iPads is coming out of Los Angeles, right? That's driving growth. Boston is not even one of our top 5 markets. It sits in that 58% of the rest of the country. Boston is on fire, right? Boston is on fire because of biotechnology. Boston has always had I think the best research hospitals in the world. It also has the confluence of the most universities in any one city, 128 universities in and around Boston. That combination has created Boston as the epicenter for biotechnology, research and development. So tremendous growth. So you just start thinking about how you can pull a portfolio together in the United States and get that tremendous diversification, provide that lower correlation in your portfolio. So when we talk to investors about a global portfolio, with that in mind, is we generally advise about a 50% allocation to the US. And then the other 50% is going to be Europe and APAC, and I'm going to leave it to Tony and Ling to talk about what their percentages should be. But as we talk about the US, I think it's helpful to say not just what it provides you from a portfolio perspective, but give you really an update on what's happening from a market perspective. And so here we talk about pricing. Okay, so to that first question earlier about the increase in returns, we would say in the US, returns have moderated and they're relatively stable. And so what we show here is the blue line are internal rates of returns that investors are expecting. This is something that we generate from all the deals that we look at, not just the ones that we close on our platform. I mean, we compared that to the BBB, right? So it's the lower risk bond yield that we compared to. And you can see here that internal rates of return have held relatively steady at around 6%. So with underlying rates declining, you've seen a historically widespread risk premium you're getting paid for to be in US core real estate today. With rates continuing to decline, at least in the near term, we're not expecting any compression from the 6% number. So if you think about that, it's very compelling from a pricing perspective for US core real estate, and we think it provides that spread and that widening spread really puts a good foundation underneath the existing pricing that we're seeing across the US market. As we look at the underlying fundamentals of the different sectors in which you can invest, and I put up here the 4 primary sectors in the United States that you could invest in. This is where people have the majority of their portfolios. I would say broadly speaking, fundamentals are relatively solid, right? There's not a lot of froth in the marketplace. As we look across at industrial, we've got industrial, retail, office, and multifamily, and I'll talk quickly before I run out of time. Industrial sector, probably the one place where we have seen froth. Most institutional investors have been underweight industrial, and industrial has gone through a secular shift because of the demand driven by e-commerce and e-commerce growth. But what you can see here is that we're looking at demand versus supply. Supply is now catching up with demand. And that's happening particularly in the more rural and suburban markets where you've got a lot of land, and so you can provide that development, that supply. So that's putting some restraints and headwinds on rent growth. So we think that will take the froth out of the industrial market, some of that froth out of the industrial market. What we like is infill. So near the rooftops, particularly in the US, we're very impatient. It's not just 2-day delivery, but now it's same-day delivery, 2-hour delivery, half-an-hour delivery. So you need to be near rooftops. These infill markets where you've got land constrained, you're near the rooftops, that demand there is continuing, and we see that sustaining. So that's really where we're focusing our attention. Retail, Tony was talking about retail here in Australia as being challenged. It's absolutely been challenged in the US, but the headlines don't tell the whole story. What we're really seeing here is that while they talk about store closures, it's actually we're seeing net positive store openings slightly. The real issue, the real story, I think, is that you're seeing the profile of who opens a store is changed dramatically. Where we spend our dollars has changed, so it's more experiential. It's food and beverage, it's health and wellness, right? Fewer apparel stores. But brick and mortar is still needed in the marketplace, in the United States, I should say, just not as much of it. What we're seeing is retailers are consolidating. They don't need as many stores. Digitally native retailers, those that started online, are opening up brick and mortar stores, just not a lot of them. So what that's telling you is that there is a bifurcation that will continue in the marketplace towards quality locations. As you see fewer stores being opened up and being more discerning about location. So you really have to focus on quality. On the office side, we see office, generally speaking, today is probably in equilibrium, right? We've seen corporate sentiment is still relatively strong, relatively positive. That continues to translate into absorption. It's very much focused on CBD, urban, dynamic type of markets. That's where employees want to be, therefore companies want to be. So we're seeing good strength in particularly tech markets and dynamic downtown. So think West Coast, Boston, Dallas. On the multifamily side, on the far right-hand side, bottom right-hand side, this is a sector that actually has been challenged in the US, primarily because it's been oversupplied. And that has put a lot of headwinds on rent growth. So while we don't talk about inflation from a broad perspective in the US, there actually is construction cost inflation. And so what's happening is you're seeing development profits for all the supply that's come into the multifamily market. It's getting thin. So we see a more muted amount of supply coming into the residential market. You're starting to see that impact your rent growth. So we're seeing a rebound in rent growth that we hadn't seen in the multifamily market for several years. It's the combination of, we think, more muted supply as well as a very strong renter. So we're seeing very low unemployment, strong wage growth, in combination with lower supply. That's putting a good foundation for multifamily as we go forward in the United States. So broadly speaking, what we'd like to hear is we think the US market fundamentals are solid. There's a very strong case for you to be going global in your portfolio, and why US should be a majority of that portfolio. We think at about 50% to provide you with the right diversification for your overall portfolio. So with that, I'm going to turn it over to Tony.
Thank you, Anne. I should just remind you, of course, that you can put your questions in now while you're listening to the speakers for the Q&A session.
Hello, everyone. Thank you. And thank you, Anne. My name's Tony McCormack, the CEO of IPFM, a joint venture between ISPT and IFM to provide member-aligned, low-cost alternative investment for international investment for investors. In the time I have available, I'll try to explain why investors, particularly Australian investors, need to consider investing internationally. In some ways, this is a pretty simple question for me to answer, because it's exactly the question that ISPT and IFM asked itself 2 years ago before it decided to launch IPFM. As tempting as it would be to speak to IPFM and our product and how much we believe in it and how good it is for potential investors to invest in Europe, I would like to, and obviously for the case for investing in Europe itself, I think we just need to take a step back and ask why we can't just keep doing what we've always done, which for many funds, when it comes to investing in property, has been to maintain a home market bias. The reason for investing in international property has been around for eons. Improved performance, improved liquidity through greater diversification, greater exposure to different economies, underlying property markets, the dominant base industries, and the tenants that work in them. And of course, the ability to capitalise on imperfectly correlated markets. So the real question is not whether to invest in international property, but why now? What's changed? ISPT's core property returns have been terrific for 25 years at just under 10% from a lowly geared, genuinely core portfolio. Whilst ISPT has had the advantage of lower fees over that time, and on any metric, 10% for core property over 25 years is fantastic. And it certainly did not have ISPT or any of its investors feeling the need to seek out alternative investment markets. But as we say, past performance is no indicator of future performance, and things are certainly changing and changing rapidly. Returns are moderating and very quickly. Over my career, a good rule of thumb I've developed is that total returns for core property are typically around only 1.5% greater than the underlying yield for the same core property. When properties averaged 7.5% in the 1990s, whether that was retail properties, large retail malls, or commercial properties on Collins and George Street, the total return for those properties was typically around 9%. With a little bit of leverage, portfolio returns were just a little bit more than that. This is explained by essentially market growth of circa 3%, less a little bit for capital depreciation and obsolescence. But as you can see in my slides, which we'll get to in a moment, Australian yields now, on a net effective basis, are only around 3.5% to 5%. Add 1.5% to that number and you don't get 9%. Retail is, in my opinion, obviously, I might be on my own on this, is in all sorts of a mess. Rents and capital values could decline by a further 15% to 20% in that sector. Industrial, whilst the market darling at the moment, we believe it simply lacks the barriers to entry to drive value longer term to offset the negative returns in retail. With an average portfolio construction of, let's say, 40% commercial, 40% retail, 20% industrial and other, we believe Australian core property returns will stabilise around 5% to 6%, but not before a number of years of even more meagre returns as retail sheds more value. Turning to the slide deck. Bond yields have been declining for 30 years. Long-term interest rates at all-time lows, and returns have continued to decline across almost all sectors. After many years of stable performance, the Australian property markets are moderating and very quickly. Risks are now to the downside. European real estate has recovered strongly, albeit slowly after the GFC. It was probably a late recoverer. And as you can see, even from the chart, there is a low correlation to the Australian market. Another thing in that chart is the declining yield curve. We've been taking capital growth, and what we're left with is a lower property curve or lower yield from which we have to get our total return. Comparing yields. You think this would be relatively simple, but it's not. Bit of a jargon alert here, and I apologise, call me out on it in question time if you like. All things being equal, Australian yields will always be quoted higher than yields quoted in Europe because of Australian conventions. We leave out transaction costs, which typically accounts for yields being around about 25 basis points higher in Australia. We overuse incentives, which faces up rents, and I'll get to that point. Australian yields are quoted on a fully leased basis, where most European yields are quoted on a passing basis, which includes vacancy. And European leases are quite different to Australian leases. They lag underlying market rental growth, and they also allow for a lot more pass-through of CapEx to tenants. So in essence, yields in Europe should in fact be lower. Incentives. I touched on the term incentives and face rents. Incentives are essentially inducements to tenants to encourage them to lease space during difficult market conditions. Well, that's the theory. It results in higher rents being paid by tenants. So you probably know this, but I just need to call it out. Essentially, if the rent was $600 for some space, often a landlord will offer you a $400 sort of incentive package and say, pay me back $1,000. So really the real rent's still $600, but the passing rent may be $1,000. It results in higher rents being paid by tenants. Australia is a world record holder when it comes to the use of incentives. Typically, incentives ran at about 2 times the vacancy level, which made a lot of sense. As vacancy increased, so too would the use of incentives, as the motivation of landlords was to lease their space. This held true in Australia in many parts of the world for many years. It doesn't hold true in Australia anymore. Australia's overuse of incentives dates back to the 1990s property crash, when incentives were introduced essentially to, again, lease space, but realistically to hold up values. They've never gone away since. To compare yields, we need to do so on a like-for-like basis. So you must do so netting out the effect of incentives. Once you do this, Australia loses its reputation as being a high-yielding, high-return market. Just turning to the chart, there's a few things on there I'd like to draw to your attention. There's a bit of information. The little red dashes are vacancy. Each of the bar charts are incentives. Each of the bar charts represent 5-year intervals. The first bar chart, the blue one, is pre-GFC, and the two other bar charts, the orange and the grey, are post-GFC. As you'd expect, post-GFC, property markets have been improving. Vacancy has been coming down, and in most markets, so too has the use of incentives. But your eye is drawn to the right-hand side of that chart, Melbourne and Sydney. At the same time that the property market has been improving, vacancy has been coming down, incentives have been going up. This is a big topic, and unfortunately, I'm going to have to leave it there because there's a lot of reasons why that is the case. But any time that you introduce something artificial to hold up a value, eventually it will reverse out, and it introduces a lot of risk. Another reason, or another factor contributing to the rapid decline in yields in Australia has been the influx of foreign capital to hit our shores, particularly Asian capital and specifically from China. Australia has been outed. We're only 2% of the world investable property market. Essentially, fund managers have built up a theoretical yield hierarchy across markets, essentially being the sharpest yield for the best property in the best market through to the worst property in the worst market. We probably sat somewhere in the middle. Maybe we weren't priced right. But one thing for sure is when Asian capital and European capital came to Australia, it bullied down what I call the fat end of the yield curve. And Chinese capital invested disproportionately in Australia than to the rest of the world. The long-term yield premium for risk for many Australian investors, lack of portfolio diversification no longer exists. Without that yield premium, the benefits of diversification can no longer be ignored. Apologies. Okay. As I said, yields need to be compared on a like-for-like basis. Turn our attention to the blue bars on the chart. They are effectively the effective yields. What you can see straight away is there's a perception in Australia that we trade yields at between 5 and 6%, and that somewhere else in the world we hear about these unbelievable yields of 2.5% to 3%, and we say we don't want them. Well, the truth of it is, yields in Australia, after you net out incentives, are typically on par with European yields. By the time you adjust for the cost of debt in those markets, and with minimal or gearing of, let's say, 30%, returns in Europe are actually higher. If we hear, as we often do, that growth is what we've got on our side, Australia's always got growth. We import our growth through immigration. I think we need to re-question that. As we can see, this can's been kicked down the road for 10 years and will probably be kicked down for another 10. The yield curve is lower and flatter, both in Australia and the UK. There's a lot of numbers here. They're not to talk through today or right now. They are, in fact, the effective yield on the first line, effective rental growth on the second, what you call a total all-equity property return on the third, and then a leveraged with 30% property return on the last. The theme, look across those numbers. There's no standout. There would have been a time, and I would have been fully supporting a home market bias when you can walk up and down Collins and George Street and collect properties at 7.5% returns that were returning 9 to 10s. But with that not being the case, I fully support greater diversification into all international markets, including Europe. So the key takeaways: the domestic outlook is deteriorating. Retail adjustments, we believe, are not fully priced in. The historical yield premium and total return premium no longer exist that once justified a home market bias. And European real estate is a very attractive diversifier and something that all Australian investors need to consider. Thank you.
Thank you, Tony. Chiang?
Good morning to everybody. It's my pleasure to be here today to share with you M&G's perspective on investing in real estate in Asia. Well, Tony and Anne have spoken about the home buyers, so my presentation doesn't have as much numbers and charts. It's more photos, pictures of Asia. Hopefully, you will visit Asia more and bring Asia home to Australia. But before I start, I'd like to give a quick introduction as to how M&G Real Estate got to where we are in Asia, and the background of the company should give you a lot of information about why we are so interested in Asia. M&G in real estate has its roots in the Prudential UK's life insurance business. So for the longest time, we've largely been investing our own balance sheet policyholders' money. Having been founded in 1848, some 30 years before the telephone was invented, real estate has always been a core holding for our real estate, our insurance business, valued for its long-term duration, matching well with long-term liabilities. M&G is relatively young, having been founded in 1931, when it offered the first mutual fund to UK savers. Today, as we combine the businesses in 2019, we are a major provider of savings and investment solutions, serving 900 institutional clients with an AUM of about $620 billion Aussies. For real estate, we are based in 12 locations. 4 of our offices are in Asia. The real estate book for us is about $58 billion, given the history, the legacy, and our long-term investment philosophy. It is largely based in Europe, and the assets we own and we manage actively are mostly in office, retail, and increasingly in industrials as well. Annually, we transact about $5 billion in deals, and for Asia, our capabilities have been built around the Pan-Asia Core Fund, which is in its 14th year of operations. The purpose of this fund is to string together a portfolio of assets in liquid, transparent markets that can generate stable, visible, durable cash flow for our investors. And as a result of that, it is a third in Australia, with roughly equal holdings in South Korea, Japan, Singapore, with a very small exposure in Hong Kong. Like tea, Asia Core actually has been around for a while, 14 years on our clock, but historically not very appreciated because most of the fund managers in Asia have taken on a strategy of high risk, high return. And quite often, when things don't go well, the entire image of Asia as a viable investment market is tainted. Once you strip away the strategic overlay to the underlying real estate fundamentals, we actually think it's a very exciting market to be included in any global investor's portfolio. Diversification in such times of elevated volatility has become very important, following the age-old adage of not putting all your eggs into one basket. Based on our experience and the work we've done to research Asia, 30% of the global real estate market is already in Asia. And just in the 5 markets covered by M&G, Singapore, Hong Kong, Korea, Japan, and Australia, it is 20% of the global total. The 10-year economic correlation is 0.6. You know, it's sort of related with the US and Europe, but we think that it is still a moderate level which justifies putting an exposure in Asia. And interestingly, for Australian investors, the correlation between Australia and the rest of the core markets in Asia is actually very low. Singapore and Australia is about 0.05, and against the other core markets, core real estate markets, it's only about an average of 0.1. Evidently, real estate is a very local game. Demand and supply trends in Singapore have got no correlation to what's going on here in Hobart. Importantly for us, we do see the value of the yield premium at 300 or more that exists above 10-year bond rates. And I was just in Sydney earlier this week. With all the central bank action happening, it looks like the premium has even widened to 400 basis points today. So clearly a very interesting space for asset allocators to be considering real estate. The next point is on growth. I share with you this picture of the bamboo, an indigenous plant to Asia. There are 1,500 species of bamboo in Asia, and some can grow at 2 centimeters an hour. So that's where it gets a little confusing. As I said earlier, a lot of times it's really the strategy overlay on top of the underlying fundamentals of real estate. For us, as we look at Asia Core, by 2030, there are 600 million more urbanites in Asia. So there's going to be a huge increase in economic activity, lots more eating, lots more shopping, lots more traveling. Between now and 2030, a dollar of every $2 spent globally will be contributed by Asia. And to take the example of Dyson, who has recently moved their headquarters from the UK to Singapore, and also embarking on an electric vehicle manufacturing plant in Singapore. And Singapore hasn't built a car since the 1960s. I think the underlying assumption here is that the products made will be sold to consumers in Asia. By 2030, 50% of the world economy will be Asia. The third point I'd like to mention is one of resilience. I share with you this image of a gate in Western Japan, the Torii of Itsukushima. This structure is made of wood that is resistant to insect and decay, was built in 1875, and has withstood numerous challenges from earthquakes, typhoons over the last 140 years. So despite the noise in the media and the press about trade tensions, whatnot, 50% of goods manufactured in Asia are actually consumed in Asia. We've got 200 billion internet users, and quite recently we had a colleague who moved to a new apartment. Everything except the television was bought online. So there's quite a lot of activity, economic activity within Asia itself. And to top that up, over a third of the unicorns are based in Asia, generating a lot more innovation and creativity, which is something that real estate can take part of. And within this backdrop, I'd just like to share with you some of the things we do for our Asia Core Fund. Clearly, long-term perspective on building long-term cash flows for our investors is the key drivers. But within this growth environment, we actually have a very unique opportunity to create core. 3 examples I list here. One is in Japan. We bought it as a 40-year-old warehouse, tore it down, rebuilt it, slapped on solar panels on top of it. It's now fit for purpose, and within 6 months of completion, we actually leased it to 100% occupancy, anchored by Coca-Cola of Japan. So it was a downtime of 2 years, but it was probably 2-3% of our $6 billion core fund. So something a core fund can easily withstand, and to also add on new assets to the portfolio. The second example is Suburna Jurong's campus. Its headquarters building we're building for them in Singapore. Suburna Jurong is a Temasek-linked entity. And in exchange for building the campus for them, we will get a 28-year lease, stable, durable cash flow for the portfolio that will complement the rest of the ingredients in our portfolio. And the last example is Centropolis in Korea. When we bought it, it was actually empty, but we've been investing in Korea for 15 years. We were able to structure an income guarantee, knowing how the market works. 9 months into our acquisition, we are 65% occupied, and still quite a couple of months away from when the income guarantee expires. So there's a lot of creativity that we can put into the portfolio to build a stream of cash flow that is durable, stable, with strong returns delivered to our customers. So Asia's full of opportunities is my final, my conclusion. It's a lot more about your execution and what you choose to do. And with that, I thank you.
Thank you, Chiang. So look, we will very shortly open this up to questions from the floor, and also, of course, don't forget via the app. Before I do that, I just want to take ask a couple of sort of big picture questions. The first one is about risk and what the biggest risk is to the various property markets in the next sort of, I suppose, 3 to 5 years, so a shorter term view. And Ling made the point there that a lot of media hype, US-China trade war, 50% intra-regional trade, so not such a big issue maybe for Asia. But what about for the US? Because you talked about the importance of domestic consumption at driving growth. We've just seen the latest round of tariffs, which have hit for the first time consumer goods. Mm-hmm. So is that the biggest risk?
So I would say that I think it plays into the recessionary fear. I mean, I would say that probably the biggest risk that you have right now is thinking about when is the next recession going to be, and how deep will that recession be. And I think in the US, I think what our team looks at is that we don't think that the trade war will put us into a recession unless it meaningfully changes consumer sentiment. So today in the US, you've got very positive consumer sentiment. Consumer spending dollars. That's continuing throughout all of these conversations about the trade war. I think if that changes, I think that becomes more of a bigger concern from the U.S. perspective, is if you see consumer sentiment change, and that tilts you closer to a recessionary environment. And
taking that into account, though, how likely do you think, on current factors, is a recession?
So yeah, our team would say that we don't think that we're in an environment where we're in an impending recession. So can this go longer for longer? The answer is probably at this point, yes, is the general feeling.
Tony, what about you? And I suppose particularly with Europe, I think I know what you're going to say, but the issue of Brexit, we just saw overnight Boris Johnson losing control of the vote. Is that a big risk? And in terms of future risk, is now the right time for Europe? I mean, if you look at places like Germany, prices are already rising because we've had very low interest rates for a very long time.
True. Yeah, look, that's an interesting point. To some extent, I'm sorry to draw it back to the Australian market, but I almost see it as an equation of you've got a yield, and how are you going to get a higher total return than that yield? You're either going to get it through growth, and I'm not sure that the growth's going to come in the Australian market as much as we might think it will. So then you could get it via the yield gap between the core property return and the cost of debt, which is a cash-on-cash return that people play very heavily in the European markets. We fret over here with debt of 20 to 30%. Europeans tend to not blink an eye at 70. So, going in there as a core fund, and I take your point, and I think this gets back to all of our strategies, is that we're not sure, as probably no one in this room, what's going to happen next. But there is a sense of, and if you argue against cycles, well, you're a brave person. But I think we are in uncharted territory post the GFC. It took us 20 years of, to some extent, overconsumption, getting ourselves to the point of the GFC, and now it's probably going to take us the better part of 20 years post the GFC to just flatline. Now, everybody has a predisposition to boom or bust, and as Anne's already spoken about, the recessionary fear. I think our base case is it's very likely we will crab crawl sideways for 20 years with not much growth in the Australian market and the European markets. The Brexit question, as you can imagine, I travel to Europe frequently. I ask everybody this question and have for the last 2 to 3 years. Nobody can give me a straight answer. I can't give you a straight answer. What we would look at is the properties and the assets that we would buy that are best suited to weather that storm. Can I just give 3 quick examples? The Koreans would love to buy 15-year leased assets because in their opinion, it just gets them past any problem from a cash flow perspective. You've got players out there, actually mostly from the US, who would love to take a more optimistic or opportunistic view, and they want to buy properties that, to some extent, take on all of the risks of Brexit. We think there's a middle ground, properties that are 7 or 8 year, what we call whales, leased for 7 or 8 years. They don't appeal to developers. They don't appeal to Koreans. Essentially, we think they're priced well enough to get you through the issues that might flow from Brexit.
Chiang, you painted quite an optimistic picture. I did note that you've got a very, very small proportion of your business in Hong Kong, possibly a good thing right now. What do you see as the biggest risks in the region?
I think it's the recalibration of where things are done, where things are built and where things are shipped or cannot be shipped. I think, that's why the fact that we're in a couple of countries is actually a good thing, because with some of these discussions on how the trade imbalance should be rebalanced, there's just quite a lot of other people that are looking for ways to get into the flows. And so that, I think, it's really a reshuffling of where things are done and where things are shipped that will drive how things pan out in the next couple of years.
Got quite a few questions on the app. This first one is confusing me, so I'm actually just going to read it as it is. It's for Anne. The AU market, I'm assuming that means Australia, but I'm thinking that this should probably be a US question. AU market is skewed towards office and retail sectors. What opportunities do you see for a move towards institutional residential?
Oh, well, that probably is an Australian question.
Mm-hmm.
So, as I understand it, in Australia, you really don't have a true institutional multifamily or rental market. It's very fragmented. It's very mom and pop. It reminds me very much of where the U.S. was probably 30 years ago, because I remember as an analyst, I wrote a white paper making the case for why we should actually invest in multifamily and what it allows you to do in your portdio. So I think what I'm hearing is that you're starting to see that kind of the marketplace starting to form around multifamily becoming an institutional opportunity here in Australia, and that there's a need and a want by renters, and what that brings is institutional dollars and therefore supply and therefore higher quality of multifamily, which kind of feeds on itself, that it becomes more of an institutional, a true sector. Today, I mean, when we started, multifamily was maybe 10% of your portfolio. Today, it's about 25% of your portfolio as that has grown. So again, I think it's an Australian question. I think it does feel like you're 20 years away from where we were, starting out sort of the multifamily institutional sector in the U.S.
That's going to take us 20 years to get to that point?
I don't know what it will take. But no, I mean, it was in the last 10 years, multifamily has really come into its own in terms of being a more meaningful part of investors' portfolios.
Tony, let me give you this one. It's undirected, but can you please talk about the C word, currency, given its impact on returns for Australian investors?
Yeah, well, it's typically been accretive, but everything we talk about is net of hedging or net of currency issues. Our product that we offer is done on a hedged and unhedged basis. So for the large institutions or funds that like to take on that risk themselves and manage it, from a portfolio perspective, they can. For the ones that don't, we'll manage it for them. I think to some extent, it's treated by many of the funds as a separate asset class. I don't like to roll it into property. I wouldn't like to be sitting here saying that our returns are going to be 8%, but actually the core property returns 4%, and we've thrown in 2% for the accretion of currency. So everything I've presented today is net of currency impact.
Ling, do you have any thoughts on currency?
We work with large institutional clients, so we typically do not include the currency overlay in what we do. Fundamentally, we're looking for people looking at the long term, and we've seen that it can go up, it can go down, and in the longer term, it's really about taking a view on where growth is, where the upside in the future is, and so we typically do not worry about it too much. Clearly, it's very volatile. It's gotten a lot, I would say, worse in the last 2-3 years. A particular hedging strategy might have worked 2 years ago and got you a couple points, but it's just been very hard. I think people are losing money for nothing in hedging to some extent, and particularly in our product. What we do in M&G, we have clients in all sorts of currencies. We've got clients from Canada, from America, from Europe, from pounds, from Hong Kong dollar, from Singapore dollar, Swiss francs. we don't know what to hedge to. So if we're working for institutional clients of the likes we work with, they generally have their own currency overlay and they'll just do it themselves. I think that's a lot easier. We just focus on the property, and the clients can focus on what sort of currency overlay they may fit their own portfolio.
Let's take a question from the floor.
Hi, it's Brendan Casey from REST. Thanks very much to the panel for some fascinating insights. Question's probably for Anne, although I'm happy for you to chip in. In the US office, do you think the better place to be is in the CBD or is it in the suburban market?
Without a doubt, the CBD. So we have an absolute CBD focus within our platform. We've actually moved over the last 10 years to basically almost 100% of our portfolio is now CBD, or what I would call dynamic urban environments, so like a Silicon Valley. And the reason being is because in the US is that the employees want to be in these dynamic markets, and so you've seen the companies move from suburban markets into the CBDs or the dynamic urban environments, and we're not seeing that trend change, even with employees moving out to the suburbs. They're moving near in suburbs, and they still want to work in those more dynamic environments. So we don't see the strength in the suburban markets and the opportunity for real rent growth in the suburban markets.
Another question via the app. Are institutional investors overlooking demographic shifts to shop local in small neighbourhood centres as opposed to mega malls, and can they buy small? And let me put that to you first, given that we have vast swathes of empty malls in the US.
So, I mean, you certainly have shop local, but I don't think that that's an overriding theme, quite honestly, in the retail sector in the U.S. It's much more about what I was talking about earlier in terms of the shifting dynamic in terms of the amount of stores that are opening and where they're opening. But I think at the end of the day, there's a real flight to quality that's happening. And in the U.S., we have, I think the number is like 24 square feet per person. It's way too much. We do not need that much retail. So there's a lot of retail that is going to go away across the United States. And I put a perspective around it as we have about 1,100 malls, and only about 150, maybe 200 are of A, quality or better in the United States. And so those other 900 malls is what you're going to hear all this noise about. They're going to close, they're going to be repurposed, something is going to happen to them. But the bifurcation is going to continue in those smaller subset of strong retail, of where the retailers are going to consolidate into those malls. And so long as investors have the capital to manage and maintain the right merchandising mix, as you've always needed to do in retail, you'll see that continued flight to quality. But yeah, I think the ultimate point is that there's a lot more noise and a lot more fallout that's going to continue to happen in the U.S. in the retail market as we move towards less retail square footage per person. But the key is being focused on the right quality type of location when you're going to be investing in retail. It's not an easy sector to be an investor in today.
Tony, a domestic perspective on that?
Yeah, I love that question. I suppose I look at, again, Europe as, almost like the birthplace of developed economies, and they're very infrastructure rich. It's one of the most highly densified places on earth, and many of the cities are. What that does is actually lead straight into that question, because with that densification, you can actually then shop local. So and I think this actually gets to the heart of some of the troubles that retail has. So where there hasn't been an investment in infrastructure and you've still got to jump in your car to do it, well, you've probably got not much choice. But where you actually can walk out of your house or your apartment and go to your streetscape and it pretty much services every need that you have within a 200-metre radius, retail will survive. And that's actually why our fund that we put together is what we call Essential Places Fund. It believes in cities. We think the cities that are winning have pretty much already won. We're not chasing sort of the 35th or 36th best city where we think there might be growth. And that all feeds into that shopping local.
Any more questions from the floor? If you have got a question while we're chatting, just put your hand up, because we have very on-the-ball spotters. Another question for you, Tony. As a startup manager with no track record of investing in UK, Europe property, how will IFPM compete with local specialists with 20 years plus track record?
Yeah, it's a good question. I'm not going to... It's always a dangerous one to start up with the track record of your competitors, but it hasn't actually been that great. So I think we would have struggled if we had have come into a sector and said everybody else has been doing 10, 12% returns, but they haven't been. I think the other thing is it also raises the question that when you think about many investors that have come to Australia, have they performed poorly? Have they actually sidled up to other managers, or have they gone at it in their own right? And in many instances have done very, very well. They've brought a global perspective. Sometimes local managers can actually be too blinkered. Our strategy, it's more about the execution. So we take Australia's probably one of the most raked over, sophisticated markets in the world. From a real estate perspective, it is. It's taken its learnings from America. It's taken its learnings from sort of its birthplace of the UK. It's combined them all, and I think it probably has some of the most sophisticated analysis. If you export that and couple it with local expertise and then what we call local operating partners, I think any manager that simply says we have all the best people all of the time is delusional. You'll never keep them. It's like having a football side and thinking that you'll always hold all of the Brownlow medalists in one side. It's impossible. So by coupling the better research, better sophistication with local experts, with local operating partners, we think that's the best execution model.
Ling, can I just ask you another question here via the app? China.
China? About what? What about China?
Yeah, the property outlook in China, and indeed the ease with which one, or the lack of ease with which one can invest.
Yeah, sure. I think there's been a change in sort of pace there, primarily because of the capital controls, I think. Tony talked about a lot of capital coming to Australia, causing everything to be a lot more expensive than before. I think of late, because of their internal requirements, the export of capital has effectively been closed. So to buy real estate in China, now it's actually not a bad idea to be selling, because a lot of this money being stuck in China is looking for product to be placed in. So if you already own Chinese assets, then it's a good time to sell. But I probably would wait a bit more before I may start on a China strategy. For us, because we are focused on core assets, I think it's quite tough to create a case in China. There is capital controls, and the financing rates are more like 6% when the underlying yield is probably 4%. So you got a negative carry. There is, this cash trap. So a lot of these things don't really fit very well with our concept of core. Not to say that there's no opportunity. I think, when it comes to a bit of a buy, fix, and sell strategy, I think China still presents a lot of opportunities. But you just got to be nimble and move with sometimes how the political cycle shifts.
We are out of time, but I just want to finish with an incredibly, as I say, you can see that red thing flashing at us, so this is putting you on the spot, absolutely. But I just want to know, country, sector that you should sell or buy right now.
Well, country is easy for me, U.S. And sector to buy, I actually think that a core office in some of these major CBDs is actually an interesting opportunity, because it's not a loved opportunity right now. There's not a lot of core money looking at the office sector, so I think it's a bit of a contrarian play as an investor coming into the market.
Any particular CBD?
We tend to like the West Coast CBDs, and as I said, Boston and Dallas, but I think actually New York right now is a really interesting opportunity, because there's just not a lot of core money going into office in New York, and New York isn't going anywhere. You can get a 5 yield, 5 income yield, and then lever that at a 3. And if you don't assume any appreciation, that's a really compelling return for long-term rented property in Manhattan. So,
and what wouldn't you touch with a barge pole right now?
We know retail really well. I would not be a buyer of retail today. I think it's just really hard to find the right retail unless you're going to buy the very top quality retail. But those people who tell you that you can go and fix retail, particularly in today's environment, I think is incredibly challenged.
Tony, country, sector?
Yeah, well, obviously different countries, but agree with...
I've just got to pick one.
Yep. I still think there is value in the UK. I think if you look at the spread that's opened up in the UK, it's decompressed by 50 basis points since Brexit, and yields have firmed on continental Europe by 100 to 150. Now, usually they move in unison. Most of these questions come back down to, do you think growth and pricing reflect each other? I just think that's too wide a spread, and I would be erring towards the residential and commercial sectors. like Anne, I would not buy retail. Country to stay away from. The one thing when you've got 25, 30 countries, it's pretty easy to pick a few that are not going to perform very well. It wouldn't come as a surprise to say Italy or Greece.
Chiang?
I think I would stay away and sell alternative type real estate. We've been in the market looking for opportunities in industrial, etc. But cold stores, data centers, I think, with the amount of capital coming to real estate, even these assets have, been attracting very high bids. And, the converts of fixed income investors into real estate, looking at real estate as a proxy, do not really think about the capital expenditure part of the equation of managing real estate. So alternative sectors may sound sexy, but I probably will not, touch it at this point in the cycle. I think it's more of a sector thing. To me, Japan is still very interesting. It's probably lower forever, and the economy is going through a lot of structural changes, which I think will provide value to investors, targeting assets that have got fit-for-purpose uses.
Thank you very much. Please join me in thanking our panel for their insights. And